Hi, Luke Hansen-MacDonald here. Welcome back to Beyond the Family Business podcast. This is part 2 of our investor series. If you missed part 1, it was on the differences between direct and indirect investing. Definitely go check that out. But if you've seen that already, today we're going to be discussing the differences between public equity and private equity investing. And to clarify, I mean advisor-led public equities and private equity funds. I'm choosing those because I believe those are the most common pathways into those asset classes, so it should apply to the largest group of people. All right, to start off, we're going to do a little history lesson. So the history of public equities goes way back to the 17th century in Holland with the Dutch East India Company. They were the first publicly traded stock, and they traded on the Amsterdam Stock Exchange. They grew to be one of the largest companies ever. Their value normalized for today's dollars is estimated to be around 8 trillion. And they had a stranglehold on the nutmeg trade as well as many other valuable commodities and products. But this was a very revolutionary thing at the time that allowed them to raise a huge amount of capital from a very diversified set of investors. And obviously this has evolved a lot over time, and now there are many different stock exchanges around the world, like the NASDAQ or the London Stock Exchange, that many investors can get access to. Whereas private equity funds are a much more recent development. There's some debate whether it was the Bessemer Trust in the early 1900s or it was American Research and Development Corporation in the mid-1900s, but regardless, it was in the 1900s that private equity funds really came on the scene, and it wasn't until the 1980s when they became popularized with leveraged buyouts. Groups like KKR and Blackstone obviously then took this to the next level and really made them mainstream, and now it is a multi-trillion-dollar a year industry, which we're going to talk about today. All right, so next, let's touch on what is probably the most important criteria to any investor: your potential return. And to cut to the chase, private equity typically outperforms public equity over a long period of time. Most of the industry reports show that private equity ends up in that sort of mid-teens range. You know, as an example, Cambridge Associates, who are a very reputable firm when it comes to private equity fund reporting, they show it's around 15.44%, and this is consistent with other reports that I've read, is that sort of mid-teen range return. Whereas for public equities, you're typically expecting more in the high single-digit, low double-digit number. And, you know, over the last decade, the S&P 500 has done really well. But if you look at a longer term period, it is sort of in that normal 7 to 9% range. So I think that's pretty consistent. There is a trade-off for that return you get on private equity, which we're going to get into next. So next, let's talk about one of the biggest differences between public and private equities, and that is liquidity. In other words, how easy it is to get access to your capital after you've invested it. So public equities are generally very liquid. The reason why? Because there is an open stock market. You can trade any blue chip stock within a matter of seconds and turn it back into cash. Now, this means there is short-term volatility in the stock market, but over the long term, you usually see that value of the underlying stock come through, and you have the ability to convert back into cash in a moment's notice, which is highly valuable to investors. Whereas private equity is highly illiquid. You're typically locked into a private equity fund for 7 to 10 years. Sometimes they'll have an option to actually extend beyond that. And while there may be short-term disbursements where you get a return of capital, but the overall position of your investment won't be returned until they've got to the end of that time period. Now, it's important to note there is a growing secondaries market where you can sell positions in private equity funds to other firms that specialize in buying those positions. Now, the issue is sometimes those are at a discount given you're getting out early. As well, many private equity firms actually put rules in place that without their consent, you are not allowed to do that. All right, next is one of the other major differences between public and private equities, which is diversification and accessibility. So with public equities, typically you have much more access to diversification. It's not hard to find a way to invest in different sectors, in different regions, in different industries. If you invest in an S&P 500 indice fund, you get access to a very broad basket of underlying investments. As well, the minimum threshold for investment, you can find stocks that are literally penny stocks. Maybe those aren't very good stocks, but the point is you can buy shares for, dollars or tens of dollars or hundreds of dollars pretty easily. So you don't need a huge amount of money to get started. That's why, I was able to get an account set up when I was a teenager and start practicing, making investments for a couple $100. Whereas on the private equity side, it's sort of the reverse. Typically accessibility is quite limited. The industry is known to be prohibitive. You often have to be an accredited investor, and the minimum thresholds in a private equity fund can be hundreds of thousands or even millions of dollars. And as well, private equity funds typically have a fairly small number of underlying investments, and those investments usually have some common thread. You'll often see a private equity fund that has a theme, around a sector or an industry or a region. And so as a result, you end up with much more concentration risk in private equity than you do in public equity. So next, let's talk about influence and control. There's much more of a subtle difference between private and public equity. There are differences, but there's a lot of similarities as well. So in private equity, you would typically be a limited partner, or what's called an LP, if you're an investor in a private equity fund, and LPs don't typically participate in the day-to-day management. That's really managed by the general partners or the GP. Unless you're a really big LP investor, you probably don't have anything other than really quarterly passive reporting on what's going on. The LPs that are really big sometimes are sitting on LP advisory committees, or LPACs as they're called, which does have some oversight of the GP and the activities of the fund. As well, the LP group does always, if they meet a certain threshold, have the ability to vote out the GP and then put their other preferred GP in place, but that's only really in extreme situations. And with public equities, it's a similar story. Most public equity investors really are in a passive position. They get their quarterly reporting, and they may attend the annual shareholders meetings, things like that. But unless you're a very big investor who's managed to get a seat on the board, or you just have a huge amount of influence as a shareholder, you're going to probably be at the whim of the CEO, executive team, and the board of directors, who really will be making the majority of the strategic and day-to-day decisions for that company. All right, next, let's talk about everybody's favorite topic, fees. So the fees and the costs associated with advisor-led public equities typically are lower than private equity funds. And I'll get into explaining why. So on public equities, usually you see around 0.5% to 2%. Now, if you're in a smaller account, you may even get charged per transaction, for example. But when you have a larger amount of capital, usually that goes away. The one downside people often point out about the way the fee structure works on public equity advisors is it's typically based on assets under management, which means they're incentivized to have the largest amount of assets under management, not necessarily to provide the best performance. Maybe they're going out and getting many more clients rather than ensuring you get a certain return. Now, on the private equity side, you usually have what's called a 2 and 20, or 2% management fee and a 20% carried interest, or a profit sharing. So you have to keep in mind with private equity, the reason why this is higher is the private equity management, or the general partners, are in charge of raising capital, finding deals, executing on deals, making sure there's adequate management in place, the oversight of those investments, investor relations, bank financing, and it goes on. So they have a much more involved role than public equity advisors do. And so that's what justifies the 2% management fee. And then the 20% profit sharing is typically above a hurdle rate, usually around 8%. So in other words, once they have met what is a public equity return, 8%, as we said, it was sort of 7 to 10% is the average. So after they've hit that 8% hurdle rate, then they get to participate in the 20% of profit sharing. In conclusion, private equity and public equity both have benefits and weaknesses. Generally, private equity provides a higher upside, but it is a higher risk profile. You're locked in for a longer period of time. You may be more concentrated as far as the sectors or the industries that you're in, and you may have a higher initial investment amount. Whereas public equities, while they have a lower return overall, they do provide a huge amount of liquidity. They give you that diversification, and there's that lower threshold of the initial investment. So you really got to figure out what you need as an investor and then figure out your portfolio mix based on that. We have a mix of both public and private equity. We like the upside of private equity, but we like the diversification and liquidity of public equity. And so we want a mix of both. So I hope this was useful. Please like and subscribe and write comments below about what other topics you would find interesting for me to discuss in this investor series. Thanks so much.